today, okay, we want to just get right into it. I want to welcome all of our viewers, all of our subscribers. Here is the Velocity channel, all right? We are going to absolutely show you how to pay off any loan. And if it's okay with you, can I just give a shout out? All right, I want to give a shout out to Cosmic. My goodness, he said, I have paid down my mortgage tremendously in the past 15 months. Can you just give him a standing ovation right now? All right, give them a standing ovation right now, because that is huge. Cosmic, you are a very valuable community member to the Velocity channel, and thank you so much for contributing that. All right, listen, we're going to hop right into it. Is that okay? It doesn't matter. Okay, can I just start with this? It doesn't matter your income that comes in. Okay, this number can be any number. All right, the number doesn't matter. What does matter is what is left over after this number. Okay, so you do have to have at least $1, okay, at least 50 cents in cash flow. Now, CJ, why are you saying at least $1, at least 50 cents in cash? Because you got to start somewhere. Okay, so we're going to show you how to pay off any loan with your line of credit. It doesn't just have to be a mortgage, doesn't just have to be a student loan, it doesn't just have to be this loan or that loan. It can be any loan. Okay, and why would you want to pay it off with your line of credit? You will soon see. All right, so now let's just take the $5,000 that comes in each month, all right, into your bank account. What are you going to usually divide that up as? Okay, those that aren't familiar with the Velocity banking method, some, they go ahead and put it in their bank account. And guess what? You got to slice the pie when you do that every time. So you're going to be putting $1,200, okay, towards the mortgage each month. You're going to be putting $600 towards your credit card payments. You're going to be putting another $600 towards your, what is that? Is that a hat? Okay, anyway, it's going real fast. Whatever it is, it's a car payment. All right, $600 toward the car payment and $1,200 towards your groceries. And they want us to save, don't they? They want us to save tremendously, and so they say, listen, you got to save a whole bunch, all right, for very little, okay, in interest back. $1,400. They want you to put it in the 401k. They want you to put it in the IRA. Listen, I say no way. Because you can do a whole lot better with your money than someone else can. All right? Absolutely. Trusting people blindly is really not the way to go. Go ahead and research, like many of our viewers do. Research every method you come across and go ahead and see if it works for yourself. But each time we get the $5,000, we slice up the pie, we pay all of our expenses, we're left with how much cash flow? $0 in cash flow. But I want to give you a kindergarten understanding of how Velocity banking works. The reason why Velocity banking works so well is because it's all about this right here. You see that? Debt transfer. You see, what you're doing is you're actually transferring your simple interest, okay, into your amortized interest. Now, these loans that I'm talking about, let's just go ahead and assume they're all amortized, okay? Absolutely. Assume that they're all amortized loans. And of course, you can get with your bank professional to see if that's really the case. But the power is you're transforming this amortized interest into simple interest. And you're using your line to chunk away at the mortgage principal. Let's just give you an example here. Let's say you had a loan of $80,000. Now that may be a student loan, but it can be any loan. Let's just say the value of it is $80,000. Well, that's amortized, isn't it? But if you have $20,000 that you can put towards this amortized loan, you're going to say, listen, Mr. Linda, Mrs. Linda, can I go ahead and place $20,000 to chunk down my amortized interest? Okay, I want to chunk down my mortgage principal, my student loan principal, my loan principal, and make sure that you say principal. Okay, you want that chunk to go to the principal, not to be divided between the principal and the interest. No way. We want it to go to the principal. All right, because the principal, okay, is what is feeding your interest. In other words, your interest, I'm going to draw a Pac-Man the best I can here. All right, your interest is feeding off of the principal. Absolutely. So all those little puffs, I know a lot of y'all are too young to remember Pac-Man, but look, those puffs that Pac-Man would eat, he's feeding off the principal. And so when you are subtracting from the principal, that's less and less that the interest monster, okay, the minimum monster, can eat. And so he grows smaller and smaller each time you're chunking away at that principal. And it doesn't matter if it's mortgage principal, if it's the student loan principal, any loan principal. Remember that it's the interest that is feeding off of the principal. And so when we chunk that principal down, the interest gets smaller and smaller and smaller. And that's why you can pay, right? You can pay $1,400 in interest versus $40,000 in interest. Okay, you remember that illustration that we made? Yeah, $1,400, you're paying $1,400 in interest on the simple interest side. But if you were to continue to pay, right, the non-velocity way, you would be paying astronomical amounts. And that's because you did not do a debt transfer. You did not pay with your line of credit. You did not chunk that mortgage principal, that student loan principal, that car loan principal, like the velocity banking shows us. All right, now, that is all you need to be concerned about. Okay, you need to be concerned about making sure that when you get your paycheck, you place it inside that line that was expended. Absolutely. Because when you place it inside of the line that has been expended already, what are you doing? Yeah, the bank says it's a pay down, but you know it as a transfer because you can use that money again. All right? Now listen, this is bite-sized, folks. We aren't done. Not at all. But it has to be bite-sized because I want each one of you to get it. So listen, there's a video coming up right after this one. It's going to be most likely the next day. It may be in the next hour or two. But I want you to pay attention to why the velocity banking really works. It's all about debt transfer. Okay? Say it with me now. Debt transfer. Okay? There's a difference between simple interest and amortized interest. And folks, we will see you in the next video. God bless, and you have a good night.